I watched this podcast, and in it they suggested that a business owner puts their labour costs into gross margin. Now, I have worked in accountancy for nearly 20 years now, and I think that that's actually a bad idea. So today I'm going to tell you exactly why that wouldn't work for the business and what I would be doing instead. Many people call it different things. Some people call it margin, some people call it gross profit, some people call it gross margin. Now, technically there are some very minute differences between them, but for the purposes of small businesses, you don't need to worry about those, and we can use all of those terms interchangeably. So when we're talking about our gross margin, we simply mean our sales less our direct costs. Now, the reason that I think including labour costs in your gross margin actually makes it very difficult for you to analyse what your true gross margin is, and this is the reason why. Now, when we're talking about gross margin, as I said, it's sales less direct costs, and a direct cost is something that varies directly with your sales volume. So we would expect there to be a correlation like this. So as your sales goes up, so do your direct costs. Now, the problem with putting labour into your gross margin is that most people these days tend to be on a full-time salary. So what you actually end up with is this effect every time you recruit a new employee. Now, just to clarify, when we're talking about labour costs, I'm not talking about your admin team, your sales team, things like that. I'm talking about if you have like a manufacturing unit, for example, your production staff, or if you've got a warehouse, your warehouse staff, would you put those costs into gross margin? Now, when you have this effect, when you include your labour costs, it makes it incredibly difficult for you to analyse your gross margin and draw any conclusions from it. What you end up doing is taking your gross margin, removing your labour costs, and then looking at what you're left with. And that is the reason why I never put labour costs into my direct costs or my gross margin calculation unless the employees or the contractor, the outsourced person, whoever it is that you're using, is paid on an hourly basis and their cost directly is linked to their output and your sales. So what is it that I recommend doing instead? Well, this is actually super simple because I recommend that you structure your profit and loss like this. So you would have your sales, you would have your cost of sales, and this cost of sales would be all of your true direct costs, not including any of your labour costs. That then allows you to see what your gross margin percentage is. Then what you want to do is you want to have a separate category on your profit and loss. And this is where most of the online bookkeeping systems, particularly Xero, is really bad at this, because at default, you have this, and then you have admin, which includes every cost in your business. And that is where the problem is. You want to split admin into maybe 4 or 5 different categories. So I always have a category for marketing costs. I always have a category for sales and production related costs. And that would be where I would be putting my labour costs. Not ever would I be putting my labour costs for salary employees into gross margin, because it makes it incredibly difficult to analyse.